Let's talk some credit. Let's talk bonds and strategy into 2025 with Jeff Rosenkranz joining us, our first guest here on Market on Close, portfolio manager at the Shelton Tactical Credit Fund. Jeff, welcome back to the show. Thanks for being here.
Thanks for having me. Good to be back, Oliver.
Lay the groundwork for us from the credit perspective. Firstly, are there any obvious minefields from a credit standpoint going into this year that we need to be stepping clear of?
Absolutely. Spreads are relatively tight by historical standards, and I think the expectation is going to be there's likely to be volatility. We have a new incoming administration that's going to attempt to enact some significant policies. So whether they can actually get some of that done in a narrow majority in Congress remains to be seen. Some of these policies have the potential to sort of set off some gyrations in terms of global macroeconomic trends. And so I think absolutely there are some causes for concern, but overall corporate credit worthiness is pretty solid. Last year was a strong year for returns and spread performance, certainly, and the lower credit quality cohorts were even stronger. So be careful with some of that strong performance, expecting it to repeat. But at the higher credit strata, double Bs, single Bs, with the recent backup in yields, we're back over 6.5% on double Bs and over 7.5% on single Bs. So these all-in yields are pretty compelling as we start the year.
Jeff, are there innate problems that will boil over at the lower quality companies just with time? Or is there an added pressure of rates that is going to drive those risks? Like, how much of the risk perspective depends on what the Fed does? Is some of this just the market pricing away the cuts that it thought maybe it was going to get?
Great question. Rates are going to certainly have an impact. If you look back to sort of August, September, last fall, we got rate cuts and there were expectations of significant additional cuts. And I think that drove a lot of the strength in the economy in the fall and early fourth quarter. And then we had the election, which set expectations for sort of even more strength in the economy. But this significant backup in rates, and a lot of it is probably attributable to the new administration and potential policies they might enact. And the market's becoming concerned about fiscal spending, but this significant rise in rates, it's tightening financial conditions for sure. And even though we got these rate cuts last year, the rates that really matter, as you mentioned, for businesses, consumers, are longer rates, right? And so the significant backup in rates is going to pinch companies that need to borrow, especially smaller companies and mid-sized companies. And then for consumers, mortgage rates, car loans, large consumer purchases, all going to be significantly more expensive at these higher rates. And so I think there was an expectation for continued declines in these rates, and we've gotten a reversal. And I think that's going to start to have an impact. And maybe, this morning, we got a revised Atlanta Fed GDP now for Q4, which showed a significant downward revision from over 3.3% just a few weeks ago to now essentially 2.5%. And so maybe that's a sign that late in the quarter, as rates started going back up again, that there started to be some slowing of that economic activity as we head into Q1. So yeah, I absolutely agree. These higher rates are going to have a real world impact on companies.
Jeff, how much range optionality you think the Fed has when the dollar keeps ripping the way it is? I mean, it's pretty amazing to see $1.09 when so many had that as part of their kind of framework coming into this year. Lower dollar. A lot of people just kind of root for lower dollar. It seems like they equate it with risk on, and maybe that's part of the mindset. But it seems like the dollar's telling us that we're in a pretty good shape compared to the rest of the world. But then if Powell can't cut anymore, then does the dollar just go berserk? Does it start to tighten the economy on its own? Is that kind of some of the mechanism?
I think you're right. I think it puts the Fed in an even more difficult spot when at a time when they are already very challenged to try and assess not only the economy, but at their last meeting, they acknowledged that at least some of the Fed governors are also starting to incorporate possible expectations for fiscal policy and the new administration as well. So as you were just talking earlier on the show, other global economies are really slowing. Can we remain, a bastion of relative strength? And I think the jury's definitely out on that. The dollar is telling us, is sending a signal there. So a lot of things all coming together, making the Fed's job incredibly difficult right now.
All right. Love the macro take, Jeff. Let's talk some themes real quick. A hard pivot over to entertainment and where folks are willing to spend. It seems like you guys are interested from the credit side in movie theaters, Six Flags, entertainment. Where does that fit into the fund?
Sure. No, those are a couple of examples of where we see value. Six Flags is one. They completed their merger with Cedar Fair last year, and Cedar Fair management is going to be running the combined company, and they're really great operators. And so we're excited about their ability to really improve the operations at the legacy Six Flags properties. And so the combined company is really going to generate a lot of cash flow over the coming years. So we like that situation. Movie theater industry is another one you mentioned. It was just starting to recover from the pandemic when the two strikes hit in 2023, the writers and the actors. And so that put a huge hole in the release schedule for the latter part of 2024, most of 2024. And so we're just now starting to come out of that hole in the schedule. We've seen it with a few good releases here later in 2024, Wicked and Moana and Sonic, but we're more excited about 2025 and 2026 now that all these studios have sort of recommitted to the theatrical release as a concept and are investing significant dollars behind it. And so the slate looks really good over the next couple of years. And I think an underappreciated aspect of the story is during this downturn for the industry, a bunch of theaters and screens have closed, so there's less capacity, but the companies themselves have gotten much better at running their operations. They've invested a bunch in additional amenities. They've gotten better at demand pricing and at concessions. And so now for every person that walks in the door, they're much more profitable in terms of the concession revenue and their efficiency. And so as we go forward here into this stronger slate, the operational leverage for these businesses is really significant and is going to start to show through. And so, yeah, that's a space we like. Cinemark is a great operator, and they've been doing well, and we're looking at other opportunities in the industry as well.
Great stuff. Love the juxtaposition there of the deep macro credit conversation. Still one in the stock picking side, the credit picking side for the company. It's fun names. Appreciate it. Thanks, Jeff.
Absolutely. Always good to talk to you. Thank you.
Likewise. All right. Entertainment, movie theaters fitting with the theme parks as well as the cruise lines that have done well. Jeff Rosenkranz. All right. There was some credit exposure in the Sheldon Tactical Credit Fund coming up. Let's talk equity ETFs and defined volatility. Interesting approach. We've got some innovative funds to talk about next.